Introduction of ratio analysis. What is ratio analysis? It is an analysis of a company's financial statement by computing the ratios and comparing them against both trend and industry averages. Now, what is ratio analysis? Is depend upon the various ratios and is based upon the DuPont framework, which identify the factors that impact return on equity. Firstly, the efficiency related ratio is related to it basically is related to how efficiently is the firm utilizing its asset. After that, leverage ratios to be considered to what degree is the company using other people's money to purchase the asset. And at the end, other financial ratio like other indication of liquidity, cash management and profitability is to be considered. Now, DuPont framework. DuPont is developed at around the 1920 is provide the systematic way to identify the general factor which causing the rate ROE to deviate from normal. So it's established a framework for computing a financial ratio to yield more in-depth analysis of a company's area of strength and weakness. And it comprises the three components: profitability, efficiency, and leverage. Return on sale, asset turnover, asset ratio, and net income divided by sales, sales divided by asset, and asset divided by equity. First, second, and third basically is related to profitability, efficiency, and leverage. Return on sale, net income is depend upon the profitability. Efficiency is based upon the asset turn, and leverage is related to the asset to equity ratio. DuPont framework. DuPont is the net income divided by sale multiplied by sales divided by asset into asset over equity. The number of wins in profit generated from each dollar of sale, and number of dollar in sales generated by each dollar of asset, and then at the end number of dollar of asset a company is able to acquire using each dollar invested by stockholder. Now we have taken example of the Colesville Corporation, in which net income sale divided by sales. Now you can see in 2008 1,80,000 divided by sales divided by asset, then asset divided by equity. It's a 3.16%, sales 2.50, and then asset over equity is 1.5. Return on equity 12.3%. In 2007, 3.11, 3.01 and 2.01, and return on equity 18.8%. So efficiency ratio is account receivable turnover is equal to sales over average account receivable, in which sales divided by average account receivable is 18.6 times your receivable turnover, but in 2008 is 14.3 times. The ratio showed that corporation collecting its receivable more rapidly in 2007 than as compared to 2000. Now efficiency receivable turnover 19.6 days, and 2008 is 25.5 days. So there is some analysis use these receivable turnover in term of the days. Now inventory turnover, cost of goods sold divided by average inventory. You can see In 2007 is 21.1 times, but in 2008 it's 14.4 times. So it means turnover allow for the evaluation of the firm's inventory position and appropriateness of the inventory size. 17.3 times is 2007, and in 2008 is 25.5 times. And as you can see, typical items on inventory remain unsold 17.3 in 2007, but number increased to 25.3 days in 2008. Now fixed asset turnover 6.60 times is, and in 2008 4.85 times. So you can see the corporation is less efficient in using a fixed asset in 2008. Margin versus turnover. Profitability of each dollar in sales sometimes calls a margin, and the degree to which assets are used to generate a sale is called a turnover. Leverage ratios. Higher leverage ratio increases it by the chain of the event, like more borrowings, more assets, more sales. So leverage ratio is basically depend upon total liability divided by total sales, in which you can see in 2007 is 50.3%, and it's in 2008 is 35.6%. So percentage of that ratio of the that company is the percentage total funds both borrowed and invested and acquiring through borrowing. You can see in that to equity ratio is 1.01, and in 2000.5%. So level of borrowing relative fund used to finance the company. Time interest earned. Earning before income tax divided by interest expenses is 5.8 times. In 2008 is 7.5 times, and time interest earned reflect the company's ability to meet interest payments and the degree of safety afforded the creditor. Now current ratio is current asset divided by current liabilities. In 2007 is 1.91. These are the common ratio, and in 2007 is 2.09. So thumb of was has current ratio is at least 2. In 2008 is good in shape. Current ratio in 2004, Coca-Cola 1.0, Delta Airline. These are the examples. McDonald's, Walmart. You can see the thumb ratio is a 2. Advances in information technology allowed successful firm to reduce the ratio to below 1. Other common ratio is the cash flow adequacy ratio. The sum of dividend payment, long-term asset purchase, long-term debt repayments. You can see in 2007 is 1.13, and earning per share net income divided by weighted number of share outstanding. Price earning ratio, dividend payout ratio is related to cash dividend divided by net income, and book to market ratio, stockholder equity divided by market value share outstanding. Now what is a fund flow? Flow of fund. The term flow means change, and therefore the term flow of funds means changes in funds or changes in working capital. So it basically relate to any increase or decrease in working capital means flow of funds. Flow statement is deal by Accounting Standard 7. It explains the changes in funds or changes in working capital. It explained the working capital position of company, which gave an idea to top management about the liquidity of company. It is a difference between current assets and current liability. Then how we can prepare the fund flow statement? Firstly, preparation of working capital statement that explain the increase or decrease in working capital. Now prepare of the funds from operation statement, in which we find out operating profit, and then prepare the fund flow statement that show the various sources and application of fund. Now you can see cash in hand and marketing investment account receivable, stock prepaid, current liabilities, fixed asset, fixed liabilities. Flow in funds, you can see cash in hand, banks account receivable, stock prepaid, means current assets and current liabilities is in a flowing. And now as well the current fixed assets and fixed liabilities also are flowing, but in a reverse manner, like in a flow in funds, in a fixed assets and fixed liabilities are linked to each other, and fixed assets and current liabilities are linked to each other. Uses of fund flow: why the liquid position of business becoming more and more balanced in step of companies making more profit. Where have the profit gone? Sources, where the sources are divided. Company are giving a dividend, no. So these are considered for the purpose of fund flows. Now fund flow analysis based upon the working capital concept. It measures the inflows and outflows of the working capital, and is a measure the analytical manner, the summarize the version of the fund for a specific period. Now you can see the cash and bank balances in the 2 year 2004 to 5, it's increases. Investments are also increasing, loan advances increases, bill receivable increases. But in a liabilities, that is a decreases in other liabilities are decreasing, short-term borrowings are decreasing, and bill for collections are decreasing. So you can see here is an increase in working capital because of the decreases in current liabilities. Now there is a calculation of the fund flow, in which the closing balance of the profit and loss are considered, and add the known fund items like depreciation of fixed asset, transfer of returns, and then the minus the known fund items which are not there, and now opening balance of profit and loss are there. Then you can calculate the fund from operation. Now these are transferred into a fund flow statements. You can see issue of capital in, and so on the side of the sources, and as well as the fund from operation, sales of fixed asset, long term borrowing, loans, and on the other side applications are increase in working capital and investment, and both sides should be equal. And if you can even the judge your the equality of the working capital, working increase in working capital by or through the fund flow statement.